Hello and good afternoon, everyone. Firstly, welcome and thank you for joining us for this webinar session presented by 274 Investment Managers. So in this session, we'll be looking at key market trends that hopefully would put you in a better position to make informed investment decisions. So we'll be looking at what's happening both in local markets as well as global markets. Of course, I'm not alone. I'm joined by a colleague of mine, Oren Tambo, who is the head of investment strategy at 274, and he's got extensive experience in equity markets as well as sort of modeling the drivers of asset class returns. So, Oren, welcome, and thank you for joining me for this discussion.
Thank you, Masood, and good afternoon, everyone.
Thanks. So look, on so far this year, I mean, if I look at quarter one, we've been having a very interesting start to the year. I think we had a very strong March that sort of failed to offset a weak start to the year. I mean, if I think back locally, specifically, the JSE All Share Index in the quarter one of this year was down by roughly 2.2%, largely due to the performance of the financial sector in particular, but also the resource sector as well. And then in March, what we saw was a sharp rise in prices, specifically precious metal prices that obviously help the resources sector, right? Inflation locally seems to be very sticky this year, delaying any thoughts of potential interest rate cuts, with the South African Reserve Bank keeping the repo rate at 8.25%. Then moving into May, obviously, we had the recent elections happening locally, and I think the outcome of the elections led to a lot of uncertainty, right? A lot of uncertainty with potential coalition scenarios that will almost certainly impact market dynamics, right? And future policies. And reading a lot of commentary that's come through, I think most analysts emphasize the need for a market-friendly coalition to sort of drive the economy through policy alignment and structural reforms. I think Oren, if history has shown us anything, is that structural reforms do take a long time to bear fruit, right? And can manifest obviously in higher growth and more jobs and so on. But we desperately need structural reforms in South Africa. In contrast to what's happening globally, I think if you look at most developed markets, they're faced with different challenges, right? Most developed markets are faced with this theme now of a disinflation trend, right? But in South Africa, we've got much more things to worry about. And I think our biggest challenge in South Africa is the issue around stagflation, high unemployment coupled with high inflation and low growth. Moving globally, I think the first quarter of this year was very positive. I think we had a very strong quarter on the global first quarter of this year on the global side, particularly within the US. I think that if you look at, and it was largely due to not only positive company earnings, but also very supportive economic data that particularly came out of the US. And I think that it sort of gave us the feeling that we would get a soft landing in that particular region, right? But enough from me. Oren, let's kick off the conversation, and you start off, and let's look at performance as a start. So if you combine quarter one and quarter two, let's look at the first half of this year, right? The performance has been relatively good. I think the MSCI World was up by 8.7%. Locally, the JSE All Share Index was up by 1.6%. So kick us off and talk to us about what were the key drivers of this performance.
Yeah, Masood, I think you hit the bullseye in your introduction. It was a very mixed performance, in the sense that we had some asset classes that had phenomenal performance during the first 5 months, and then we had other asset classes which sort of struggled. So I think if you look at developed market equities, for instance, you mentioned the US. Those markets did exceptionally well. So as you can see in terms of the numbers that are on the screen here, with the US was up 10.27%, which are the numbers in red. If you look at the UK equities, 6.62%. Let me say Europe, that is the euro area, was up 6.13%. Very strong performance, no doubt, from offshore equities. We also had very good numbers as well from commodities. So if you can look at the commodities index on the screen, which was up 7%, and within that commodities index, we had particularly strong performance from gold, which was up 12.8%. Another market that also did well during the first 5 months was China. We saw the recovery in China. I think sentiment started to improve towards China. We've seen some of the foreign capital starting to flow back to China, and that supported the performance in Chinese equities. But the performance kind of died off towards the end of the first 5 months. So you notice that when you look at the performance in China at the end of May was much softer than it was probably at the end of April. So I think those are the markets that did well. Then we had, outside of those, the performance wasn't too great to be honest. So you've mentioned domestic markets. So if you look at the domestic markets performance with the Aussie, had a very measly performance, just below 2% during the 5 months. And what is interesting in that number is a lot of that performance actually came through during the month of April. So we had a very strong performance in April. And when you break down that performance, it was predominantly Anglo-American, because of the bid that was put forward by BHP. Did some calculations, and Anglo-American stock probably contributed close to 40% of the performance in the capped SWIX during that month. Then we had also Naspers and Prosus, coming up strongly because of tailwinds that were coming from China. So it was also a bit concentrated to some extent, that performance. And of course, we did lose some of that, during the month of May, essentially because of the election anxiety that we saw. So domestic market wasn't good. Another asset class that also didn't do well was in terms of global bonds. So as you can see, the global aggregate bond index was down 3%. Inflation linkers as well globally were down, and we've got emerging market debt, somewhat, managing to echo out about 2%. But generally, again, I think what you can see is that within the bond sector, there was quite a lot of slack in that asset class. So it was a mixed performance. And then coming to the second part of your question in terms of what were the key drivers, the way we think about performance at a top level is just to dissect the drivers, whether they are bottom-up factors that are driving the performance, or it's because of the macro factors. And I think it was a mix of both, depending on what you're looking at. Our view is that when you look at the performance in the US, we believe that it was predominantly bottom up. Why are we saying this? If you take steps back to January, when you came into 2024, there was an expectation that the macro environment is going to be very conducive. The Fed is going to cut by 7 times during the course of the year. Inflation is going to come down very dramatically. It was at about 3.4 at the beginning of the year, and it's going to come down to close to 2%. Those things haven't happened. The Fed is not cut. They have met this work again, and I think the outcome is pretty much similar. So and when you look at what investors are expecting in terms of interest rates, they have cut back in terms of interest rate cuts for the US probably to 1 if you're very optimistic. But otherwise, quite a lot of investors are saying that you're not going to get it. So it wasn't a macro story in our view. It was rather a bottom-up story. It was about the earnings. So when you look at how the US companies have performed, so year on year, if you look at S&P 500 companies, they managed to deliver year-on-year earnings growth of about 5.4% during Q1, which is the highest since the second quarter of 2022, right? You look at Q2 earnings that we are actually following right now. The estimate is that we're going to see year-on-year growth of around 5.9%, again, which is going to be very strong. And I think when you also look at those earnings, you look at the companies that have been able to deliver very good earnings, which are the sectors within the tech sector, communication services. Those were the sectors that were delivered in terms of performance in the US. So it was pretty much a bottom-up story in the US. But I think when you go outside of the US now, looking at other markets, say for instance, if you look at Europe, Europe did relatively okay in terms of performance, but we believe that it was a macro story in the sense that the economic data that was coming out of Europe was less bad than what the market was expecting. So Europe at some point was expected to, it entered into technical recession actually towards the end of 2023, but it appears to have, essentially risen out of that technical recession. So that was the key driver for us, I think, that we saw in Europe. There were bottom-up factors as well, but I think the macro were the dominant driver there. If you look at Japan, one of the best performing markets. So interesting stats that are coming out of Japan. During the first year to date, Japan was up 17% in yen, in the local currency, but obviously because of the weakness in their currency, I think when you convert to dollars, it might not look as great, but in the local currency, it was up 17%. And I think for the first time we saw the Japanese stock market breaking the 1989 record. So it managed to beat that record of 1989. That kind of give you an indication of things have been bad in Japan. The fact that it took them so long for them to be able to beat that record. It was in macro story again. Corporate governance reforms happening in Japan. The Bank of Japan raising interest rates for the first time, reflecting their confidence that they've been able to beat the deflation, problem that they've been facing in Japan. So it was a macro story. Come back to South Africa, I think you have pretty much talked about it. I'm not going to spend time on it. I think it was, pessimism around elections. I think that is what weighed on our markets. So the dynamics that we saw, following these markets on a month-to-month basis, we think there was a lot of pessimism for the first 3 months. And that pessimism was predominantly, driven about investors looking at the potential outcomes, but that seemed to have sort of bottomed out towards the end of March. And when that has happened, then we started seeing markets recovering again. But again, we see the sell-off happening during elections itself, when people realized that, what we were expecting, which was, ANC getting around 45% or above, and forming a coalition with the smaller parties is not going to happen, because now the ANC is at around 41%. And then we see that sell-off and the weakness in the rand. So it was pretty much a macro story. And just penning off, I think, looking at bonds, I think that it was very clear the delay in the rate cuts in the US is what really put pressure on bonds, but also what we have started to see more recently, particularly I think when you look at the US Treasury, is investors not becoming a little bit concerned about the debt trajectory of most of these developed countries. So we have seen, I think, event that happened a couple of weeks ago, whereby the US Treasury went to the market. They made an issuance, a large issuance of debt, and the demand was not that great. It was they managed to get buyers of the debt which they were selling, but it was not as strong as what they've seen previously. And the market is starting to think that, probably we're getting to a point where the US might actually struggle to get buyers of its debt. So I think in a nutshell, I've just given you a very, sort of holistic picture, but it was a combination of both macro and bottom-up factors, with the US coming out very strongly, I think, on the bottom-up factors.
Yeah. Thanks, Oren. Before we continue, I think just a note to all our investors and financial advisors that is on this call. If you do have any questions during this session, and I'm sure there will be, please use the chat function and type them in, and we'll get to them at the end. We'll leave, like I said, about 10 minutes at the end for question time. Oren, just coming back to a comment that you made specifically around interest rates right now. I remember in the first macro update that we did for the year, right? You specifically were very skeptical about this market optimism around potential interest rate cuts during the year, right? So look, you've obviously got a crystal ball, because it seems like you were right. So maybe give us some thoughts on that. I mean, just off the top of my head, I mean, we haven't seen any meaningful cuts. I think off the top of my head, I think Bank of Canada cut by 25 basis points recently, but other than that, I can't think so. Maybe talk to us about why the Fed, for example, and most central banks haven't yet thought of cuts during the course of this year?
Yeah, so I think, I think we're very, it's a view that wasn't very popular at the beginning of the year to say that you're probably not going to get a lot of cuts this year. And for us, I think it's always very important to base your calls on what the data is telling you, not on what you want. I know everybody wants central banks to cut rates, because what it does is that if you cut rates, then it lowers the discount rate for your, valuations, for the number crunchers, the guys that do the valuations of assets. But it has to be driven by data. And this is our thought process was essentially, we looked at how the central banks make these decisions. Every central bank has got an objective. So if you think about it, the Fed has got two objectives, which is maximum employment and stable prices. So in other words, it has to keep inflation at a certain level. And according, they've given themselves a target of keeping inflation at around 2%. And the SRB and the ECB, they've got a strong focus on price stability, right? And the way we're thinking about it was just to ask ourselves and say, okay, fine, let's look at the data that we have. How far are these central banks from achieving their objectives? So I think, Fungai, if you can go back to the slide. So when we looked at the US, just focusing particularly on the growth side of things, I think what was coming out very strongly at the beginning of the year, I think this chart would sort of clarify that. If you look at the PMIs, what was very clear. So if you look at the bar, which is if you look at the 2023 December reading. So if you just focus on the US, for instance, I think what is coming out there on the US composite is that the PMI composite was already above 50. So usually when you've got a composite reading which is above 50, it tells you that there is a bit of expansion happening. So in our mind, we could easily see that the manufacturing sector, which has come under pressure because of monetary policy tightening, was starting to recover already. So which means that when it comes to maximum employment, it doesn't appear that the Fed is going to have a problem on the economy side, right? And I think you can also look at other markets. So if you look at the Eurozone was in a different story, right? It was coming from a very low base, but again, the same picture was happening in the sense that it was starting to pick up as well. And the same applies to South Africa. So I think our conclusion at the end of the day was that when it comes to the first objective of the Fed, which is economic growth, it doesn't seem to be far away, from achieving that particular objective. The second objective, obviously, is inflation. So if you go to the next slide, we had to look at the inflation numbers. And what came out was that, I mean, if you just go cast your eyes to the beginning of 2024, that is, it's not very clear, right? Inflation had come down from very high levels. So if you look at the US, for instance, it had gone up to close to 10%. We had the UK whereby it was elevated above 10%. You had the Eurozone as well, which was quite high, close to 10%. All markets had actually very high inflation in 2022, but that inflation number had come down very dramatically during that phase one that you can see there, and we're sitting pretty much at the end of phase one. So what the market did was to just extrapolate that you had inflation which was sitting at 10%. At the end of 2023, that inflation number is sitting at about, just above 4%. And like, okay, investors are like, it's going to take us a couple of months to go to 2%. But I think what investors didn't look at is to understand why the inflation had come down so dramatically, and what was left for the banks to achieve the 2%. And you can see that phase one was basically acyclical inflation. So that is inflation that is pretty much nothing to do with economic activity. That's because of industrial factors. And I think at the time it was because of logistical blockages that everybody was struggling with. Right, those were the factors that had come out of the way, and as a result, we started seeing inflation coming down. The component that is linked to economic performance hasn't really come down at the point. It was actually still going up, and for us, that was the biggest concern, to say if this component is not really coming down, and as I've indicated in the previous slide, economic growth is starting to pick up. This combination is actually not good for inflation trajectory. So we could pick, I think, very quickly that you know what, I think it's going to take a little bit longer, you know, for central banks to get inflation back to where they want it to be, longer than what the market is expecting. And essentially, that's what we're seeing. When you look at the U.S. inflation now, I mean, all the goods inflation, the cyclical inflation drivers have pretty much been, you know, washed out of the system, and what is left at the moment is you know, those cyclical components. Those are not going to be easy in our view to get rid of. It usually takes, you know, some slack in the economy or some slack in the labor market, you know, for you to be able to achieve that. So that was our thought process, and we said, you know what, it doesn't look like investors are going to get what they want. And I mean, our guess was right. You know, every projection that you get there, most of the time, I mean, it amounts to a guess. But I think we guessed it right. And what we've seen is the Fed is not cut. And looking forward at the moment, we probably, I think, if we're lucky, we maybe get one cut from, you know, one cut from the Fed. We're going to talk about it later on, but yeah, I think that was the thought process around our trajectory for interest rates.
So it seems to me that the economy is still very resilient, right? And that seems to be the trend there. But given that, I mean, coming back to the macro update that we did at the beginning of the year, at the start of the year, right, there was a concern around the economy going into a recession, right? There was a risk of a recession at the start of the year. Given the current economic data that is out there, and obviously we're examining all of these data and the latest data that comes out, looking at that, do you still feel that that is a concern? Do you still think that there is a major risk that a recession could take place?
No, so I think our view is that the risk of a recession now is very benign. We don't see that happening. So when you think about the US, if we start off, it's the largest economy in the world, you know, and you always have to start there. So if you think about the US, you have to think what drives economic growth in the US. It's consumers that have to buy, right? And when you look at the consumer health at the moment, it remains very healthy. You know, delinquencies are very low. Debt delinquencies are very low. Their balance sheet actually is strong. The savings rates are still, you know, yes, they're probably lower than historical averages, but not at a level that is concerning. So I think what comes out is that the U.S. consumer is still able to buy, even though they are crying that, you know, they're suffering from the cost of living, you know, which has gone up. But overall, I think they are in good shape. That's the starting point. Businesses as well in the US are in good shape. They're very confident. So when you look at things like plans to invest or to expand or to buy inventories, you know, things like that, we can still see that those indicators are telling us that the US business is also in good stead. And also, I think the labor market, as you can see in front of you right now, yes, there has been some bit of you know, softening or some, you know, the trend has started to point downwards a little bit. But if you think about it, when you look at the layoffs, you know, they remain low by historical standards. That's the first chart that you see there. If you look at job postings, you know, the latest number that we had was you know, was a blowout, right? We had about, I know, the US economy creating 272,000 jobs. I think the market was expecting something in the region of, you know, 100 and something. When the market created less jobs in April, which was 165,000, the market was like, yeah, that recession is coming. Then the next month, you know, you just see the US. It's a beast, to be very frank with you. It's all economists are trying to understand why the U.S. economy remain so resilient, right? And I think the data is telling us that this you know, trajectory that we're seeing for the U.S. is going to kind of you know, remain, particularly I think when you look at the U.S. And I think if you just go to the next slide, just looking at as well as what, you know, other professional economists are thinking, so just using the IMF, and you can also see the trajectory that the IMF is expecting. They have upgraded you know, GDP outlook for most major economies, and to think about major economies, maybe 5 years ago, 6 years ago, if the US grows by 8.8%, people will be happy about it. Because it's a very big economy, right? Growing at 1.8 is a good number. But we are seeing that the trajectory is basically telling us that the US is going to continue growing above trend, which is above 2%. The euro area is expected to grow above trend. The UK is also expected to grow above trend. So you put those economies together, then you slot in China there. China is growing at about 5%. Yes, it's lower than what it was growing at a couple of years ago. India is growing at 6%. So generally, I think what you begin to see is that all the major economies in terms of growth trajectory, it's actually looking very good. It's going to be very difficult for you to break that in a couple of months, and then all of a sudden start talking about the recession. So, but you can never be confident, right? I mean, anything can happen. And so, in our view, I think in terms of probabilities, we just see a very low probability of a global recession at this point in time, simply because of the backdrop that I've provided you.
Okay, I mean, looking at the IMA inflation projections, they seem to think that inflation would come under control in most economies. But look, you've painted a picture for us, Odin. And I think given what you just suggested, what is your outlook on interest rates, both locally and globally? Like, give us some insight into what you think the SARB would do over the coming quarters.
Yeah. So I think if you can go to the next slide. So if we could perhaps just start with unfortunately we didn't put a slide on South Africa, but if you can just go to the one with the one that you were at, Afungai. So if you think about South Africa, we go back to my question to say, what does the SRB seek to achieve, right? And the main goal for the SRB is obviously price stability. When you read the documentation in terms of its mandate, you come across sustainable growth, blah, 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 right? Which is the same thing that you find in the ECB. But at the end of the day, we know that their number one goal is to ensure price stability. All right. And when you look at South African inflation at the moment, we've got inflation which is sitting at around, it has come down quite nicely. It's now close to 5%. Yes, it's still far away from, the 4.5% that the midpoint, that usually the SRB want inflation to be. But when you look at the core inflation is almost there. So in other words, I think what you're starting to see is that inflation appears to be coming to a level where it's within the good range where you want it to be. But this is the most interesting thing in terms of how we're thinking about it. Coming back to politics, all right. As we're speaking right now, we understand what's going on in South Africa. We have got the prospect of government of national unity essentially happening. We've had announcements from IFP, we've had announcements from a number of people that have got inside information. It appears that we're probably going to get a government of national unity, probably between the ANC, the DA, IFP. And look, I mean, investors probably never envisaged a scenario of a GNU. They would have loved to have ANC DA, right? Which is, it ticks a lot of boxes. But having NCDA, IFP, and probably PA coming into the play, I was listening to Gate, Mackenzie yesterday when he was speaking. It appears that he's kind of moving towards a GNU. I believe that, I mean, the EFF have been making a lot of noise, but I think eventually they're just going to see that they're in the cold. Maybe they'll come along and join everybody. So we're going to have this, government that is composed. That's pretty much your rainbow government that you've always, that was created in 1994. That is going to be positive, just in terms of sentiment and perception for South Africa. If that happens, you could see the rand strengthening, and we understand the impact that the knock-on effect that the rand have when it comes to South African inflation. So we could see actually inflation softening further if the scenario that I've painted around politics plays out. So I think overall, we are basically saying that once that happens, I think it gives the SRB a bit of wiggle room for it to cut. So there is a possibility that we could have maybe one or two cuts probably at most. from the South African Reserve Bank. So that's the SRB. And just moving on globally to the Fed. So the challenge with the Fed, if you can go to that slide. So I think the challenge with the Fed at the moment, what you can see is that if you believe that the neutral rate is the rate whereby you are able to essentially, it's like the sweet spot where you're basically saying, the economy is going to grow sustainably at a good level. At the same time, inflation is not going to shoot out. If you believe that, it means that where we are currently is basically telling that the Fed should start cutting at some point in time. But we know that, the calculation, for the first time, we've seen these calculations of neutral rates essentially being unable to predict what is going to happen in the future, right? But when you look at the fundamentals, again, just to focus on where inflation is, inflation hasn't really come down to where it's supposed to be, and I think the Fed is going to be very very cautious on that front. If inflation comes down, quick enough, we might actually see the Fed cutting perhaps once, during the course of the second half. But we're not very optimistic for any cuts that are more than that. We just don't think that there is an impetus for them to do that. Economy is okay, is functioning, right? Inflation is coming down. So I think they need to exercise a bit of patience so that they don't end up breaking one of the two things. If they cut very quickly, that could fuel inflation again, and you see inflation spiking. If they probably hold out for too long, that might actually break the economy. So I think they're kind of trying to find that balance. And for us, that according to our models, we're probably seeing one cut happening, during the course of this year. Moving on to the likes of ECB, I think probably going to have one or two more cuts. They have to stimulate the economy. The inflation, when you look at core inflation, has also come down quite nicely. And we've seen what have happened in Canada. They have cut. Canada has got a core inflation of around 1.2% there. They have no inflation problem. They've got an economy problem. The economy is not growing as fast as it should, right? So I think when you put together all the different central banks, Bank of England as well, inflation has really come down dramatically. They're sitting at around 2.6%, but just like the ECB, they've got an economy problem. So I think those are the different dynamics. So we might actually, I think there is a reason for Bank of England as well to cut. The only bank that doesn't really have to have a strong reason to cut at this point in time is the Fed. So we might actually see the Fed being the last one to cut within the group of the central banks that I've talked about.
Yeah, I think that sums it up quite nicely, and it puts it all together. Coming back to South Africa, if you're a South African investor or even a global investor looking at South Africa, right? How would you position yourself in terms of the potential government shift in policy, right? So from an investor point of view, what would you look for?
Yeah. Look, so I think what is happening is we are getting into an uncharted territory, right? We've never been, I've seen that. We've been in a scenario where we've got coalitions. 94 to 99 was a coalition, but we're talking about post 99. We actually had forgotten about how it looked like. It was different dynamics back then, right? But I think overall, it's something that we're not very familiar with. We haven't had it in so many years, in the sense that we've got the ANC getting, less than 50%, and therefore it requires a partner for it to form a government. And I think what's important, if you just want to reduce it to what exactly as an investor should I be looking at, whatever outcome that is going to eventually be signed by these different parties. I think the focus should be on policy. What does it mean for policy direction? That's the first thing. And what does it mean for stability? Those are the two sort of important things, right? So if we could, just look at the different approaches that we have. So obviously, I think what you see on the screen right now is the different ways in which you can form a government. We've got a coalition agreement whereby you've got, just a number of parties coming together, and then we know how coalition works. We've had them we've had coalitions before, obviously, I think at metro levels. We've had coalitions as well. I think if you go back to around 2008, 2009, we had a coalition at some point in Western Cape, just at the time when DA didn't have the majority in Western Cape. We also had one, I think, in KwaZulu-Natal at some point in time. So we know how that works, and I think usually they've been very unstable. They've been very chaotic. The second option is obviously just to sign confidence and supply agreement is something that I think we're not very familiar with, but it's happening elsewhere in Europe, where coalitions are very pervasive. You can also have a government of national unity, which I think at this point in time, according to what we are getting, is that obviously I think the ANC has come out and indicated that as the party that got the highest number of votes, it is willing to get into a government of national unity. And we've seen the Democratic Alliance also coming forward and say, we think that this is the best way forward. And our understanding, obviously, I think according to the news, is that they've already signed an agreement with the ANC, the IFP, the PA, we're talking about it. So that's where we are. So now the question is, if we just want to reduce that particular scenario to the two aspects that I've talked about, in other countries, GNUs have not been that stable. That's one of the issues. But in the sense of South Africa, it might actually be the opposite. It's probably going to have a stability, and the reason why we think it might be stable is twofold. I think the first point is that there is no party apart from the ANC which would have power over this particular agreement. So if you think about it, if you have the DA and the ANC, they've got 60% of the vote. If you bring into that mix the IFP, probably 3-4%, they go to around 63%. If you manage to bring in the EFF, it means that you're probably sitting at 70, it's more than 70%. If you bring in the PA as well, 2-3% there, it means that you're probably sitting at close to 80%. So these other opposition parties cannot hold that sort of government to ransom, which is what has been happening at coalition level, whereby you've got this party which has got 2%, but it knows that the moment it walks out, the coalition is going to collapse, and they're basically just making very ridiculous demands. So I think in this particular case, it's not going to happen. That's the first thinking from our point of view. The second thinking is it gives us confidence because the two largest parties in that agreement are not dependent on individuals. Usually the decision-making process is collective decision-making process. Think about the ANC. Yes, we've got President Ramaphosa as the president, but he's not going to just make a decision on his own and walk around and just say whatever he wants, like what we see with other political parties. He has to always consult the NEC. He always has to go back to the ANC and get a collective decision. And usually that mechanism tend to protect certain agreements. The same with DA. I think if you see what the DA has done, it has been open, transparent. All the decisions or discussions have pretty much been in the open to say this is what we want, this is how we do it. So I think that gives us a bit of confidence that if those two parties are in the agreement, it's unlikely to break. So I think on the area of stability, if that agreement is signed, it's probably in our view going to be the the best outcome for the country. Then in terms of policy, I mean that's going to be uncertain, Masood, because we don't know how they have to sit down and agree and share in terms of roles, in terms of positions, etc., etc. They also have to contest in terms of what they are going to do. So I think in terms of policy, it's going to be a little bit volatile, a little bit uncertain for the first few weeks, but it's probably going to take shape and give us an indication in terms of direction of where things will be going in the next couple of months. But I think overall, according to our assessment, if this agreement is signed, I will know tomorrow, obviously, I think because there's going to be an election of the president, and we can see the direction where things will be going. And if this happens, it will be good for South Africa. The perception of foreign investors is going to be changed because obviously there's no way the ANC is going to continue doing what it has been doing. The challenge that we've had in South Africa is that it has become sort of a train which was moving in one direction, actually the wrong, bad direction, right? It was moving south. And got into a point where it seemed that, it's not going to stop. But I think if you have an agreement like this, it appears that you might actually put brakes and it might take a different direction. So I think it's going to be positive in terms of perception outside. And our view is that when you look at South African assets, whether you're looking at bonds, whether you're looking at equities, they have been carrying a discount because of bad politics, to be frank. And as a result, I think when that happens, we're going to see a scenario in a way, essentially, I think, South African assets are going to recover. So if you're invested in South African assets at this point in time, our view is that, just hold on to them until, you've got a view in terms of how things are. We've got a positive view. So if you look at, if you probably just go to the next slide, I think, which gives an overall view in terms of different asset classes. I think what you're going to notice is that we have got neutral to positive when it comes to South African bonds, when it comes to South African equity. And I think our positive is actually very speculative in the sense that I think the political environment is going to change over the couple of months. I was looking at the demands for the DA. It's basically a cut and paste from the Vulindlela program, which the ANC has been implementing. So there is common understanding around the reforms that you're talking about. So if we happen to have this government, it appears that we might actually have to fast track those reforms and get the economy to work again. If that happens, we might actually see a different outlook to South African equities as well as South African bonds.
Okay. If we could just perhaps go back 1 or 2 slides. So to summarize, in those pathways post-elections, those scenarios that you painted us, pathway 1, 2, and 3, and 4, you're saying that markets suggest that the GNU that's being proposed by the ANC would be the best outcome.
Yeah, definitely. I think that's our thinking. We think that the government of national unity is going to be the best outcome. It's most inclusive. I like it because the biggest concern, I think, when you look at the politics that has been happening in South Africa, is that it has become very polarized in the sense that political parties have been divided across racial lines. They started to divide across tribal lines. And you don't want your politics to be like that. You want your politics to be divided along ideas, to say, I believe in this particular idea, then I go to a political party that espouses that particular idea. But it has become something else, right? And I think, the GNU, in my view, is an opportunity to reset so that we can have a very diverse, government, which in part, it's got all the different colors of the rainbow in South Africa. And I mean, and the fact that it includes everybody. So it's going to be difficult to manage, no doubt about it. Managing multiple partners with competing objectives, it's just difficult. But I think overall, I think it's going to be the best outcome. So there's an outcome that we never talked about, right? The minority government. So I think it's something that is starting to come out, that it's possible to actually have a minority government. So when you look at the voting system for parliament, it allows, because what's basically going to happen on Friday is that members are going to be asked to provide nominations for president. Let's say we've got 5 candidates that have been put forward. And then from those 5 candidates, political parties have to vote. Assuming that each political party puts its own president, right? They're going to vote for their own president. So there will be no one candidate who's going to get the 50%. And what will happen after that is they have to cut the last, they have to cut the last candidates who got the lowest votes, and then rerun the election until you've got 2 candidates, which means eventually you're going to get one candidate that is going to get more than 50%, and that candidate can now go ahead and form a government. But it's going to be railroaded across the way. It brings anything to
Seems
parliament.
Unlikely.
Exactly, so it's something that you would want to happen. If that happens, then yeah, definitely, I think we start being very concerned on South African markets.
Okay, Oren, now let's tie everything together and maybe let's just spend 5 minutes on this, right? So you've got the macroeconomic macroeconomic environment, which we discussed in detail. We've got sentiment, we've got valuations of asset classes. Talk to me about what your outlook is for the rest of this year, and more in particular, coming back to 27/4, how are we going to position our portfolios in light of this backdrop and picture that we've painted?
Yeah. So I think if I can just summarize very quickly, I think Fungai, if you can just got the slides after this, I think they're on the appendix. They kind of give you how we think about things. So we always start, our view is that if you can go the previous slide, I think the key takeaway is that we see the second half of, if you can go to the next slide, please. Yeah, you're getting lost. The slide after that, please. All right. So the way we see things is that, right, we see the second half. Our view is that the second half is likely to see further diminishing tail risks of recession and the sticky inflation. So those are things that we used to worry about. And I think I've talked about the fact that the global manufacturing cycle is turning, while the service sectors are essentially remaining resilient. So that's good for growth. If you can go to the next slide. In terms of inflation, the disinflation trend in our view is going to continue, albeit, at a very slower pace and in a non-linear fashion. So some markets are going to see faster disinflation while others are not. Monetary policy is probably going to remain very restrictive, but the good thing is that, the guidance that we're seeing is now more optimistic. And in terms of financial conditions, which are very critical, I think when you look at the consumers, financial conditions have modestly eased. So if you cut rates at any point in time, that's going to be good for financial conditions. Earnings as well, I think for companies, particularly when you look at the global companies, we see earnings are remaining very resilient. And again, I think when you look at the geopolitics, which is one of the issues that we focus on, our tech, again, there is the biggest geopolitical risk that we've been having was in the Middle East. But I think with what's happening there, it appears that it's moving in the right direction, in the sense that there's probably a UN agreement in terms of a ceasefire and a way forward. So there is a bit of easing of geopolitical risk there. But of course, we've got other geopolitical frictions that we're watching: China, US, Taiwan, all those kind of things. But I think overall, it appears that all the macroeconomic risks are pretty much coming to a point where they're easing. So what does that mean? So at the end of the day, I think what that means is that when you go to the global market, you're basically moving away from making those macro calls and focusing. So you're moving away from beta and now focusing on very company-specific issues. So you want to be to have very good stock pickers in your portfolio, who can be able to focus on what the companies are offering. So you're looking at the company fundamentals. So overall, I think in terms of asset classes, we're still very constructive on offshore equity, so US equities. Of course, the way we have created our portfolios ourselves is to make sure that we de-risk ourselves from the most expensive ones. So we're picking up quite a lot of mid caps and other companies within the S&P 500 that are less expensive. We still think that Europe is a good market to be. China as well is offering a lot of promise. If you've got a bit of appetite for risk, it's always going to be volatile when it comes to China. At the moment in our portfolios, we had been, when it comes to South Africa, we have been sort of cautious. So in other words, we're kind of sitting at neutral level. But I think more recently, what we've done in South Africa is to try and moving forward, we're more comfortable, I think, in our view, with where the election outcome is going. We were not very comfortable previously. We didn't want to even start guessing and speculating about it. But I think what we see on the ground, we're more comfortable. So we also think that is, generally good for different asset classes. So you can basically see that macro risk is going to be benign. And whenever macro risk is benign, that's when things like your valuations and company specific or asset class specific, come into play.
Okay, thanks, Aaron. There's a few questions that come through in the chat function. So let's take some of those questions, Aaron. So the first question asks sort of the South African rand has historically been susceptible to external shocks and currency fluctuations. What factors do you believe will drive the valuation of the rand in the coming months, and how can investors position themselves to sort of capitalize on currency movements?
Yeah, so I think that's a very important question. So and I think looking at the rand. So if you want to look at the rand compared to other currencies within the emerging market bucket, it's probably the most volatile currency that you can meet, right? There was a time when I was looking at Egyptian currency and Moroccan currency, North Africa, for example. They trade on a very narrow band, like very, very narrow band against the USD. Even if you look at the Brazilian real, if you go to Mexico, most of those currencies are not as volatile as South African currency. And the reason why our currency is weak is because of the capital controls. The SRB has pretty much moved back to say we don't want to put controls in terms of how much comes to South Africa and how much leaves South Africa. So you find that foreign investors can easily come to the JSE, pump money into the JSE, and if they just feel that, things are not okay here, they can walk out tomorrow very easily. That doesn't happen in most of the other emerging markets. So you should expect that to obviously happen after elections. If the outcome is positive, I think what you could see is you can see a lot of money coming to South Africa, which would be good, I think, for our markets. So that means that you might actually see the rand strengthening. And if the rand strengthens, so this is the dilemma that South Africans have, right? If the rand strengthens, it means that your returns on the offshore side are being limited, because when you look at the performance of the S&P 500 in rands over the past 10 years, perhaps maybe 42% of that was because of the weakening of the rand. And all of a sudden, you don't have that kicker. It means that you're starting to get sort of your solid dollar returns from the offshore side. So I think it's a matter of then seeing how you can balance, your domestic allocation and offshore allocation, taking into account that usually the rand tends to be correlated with the performance on the domestic side and uncorrelated with the performance on the offshore side, and it tends to kind of offset your returns. So if it strengthens, it means that things are good on the South African side. It means that your domestic assets are doing well. But at the same time, it means that your offshore side is coming under pressure. So yeah, so I think your currency management in that particular case becomes very important. So I think with us in some of our portfolios, when you feel that there's going to be those sizable moves, we tend to kind of hedge currency for a while, so that we cushion our portfolios from the volatilities of currency. And usually, that works out. If you get your call right, it means that you're going to get the crude returns from the offshore side, and then you benefit from the uplift that will be happening on the domestic side.
Okay, another question has come through. Has the grey listing had any effect on our economy? And when do you think we will be delisted?
Yeah, so it's something that we haven't been talking about lately. But our understanding is that the government has been working behind doors to make sure that the country is removed from that grey listing. There's been quite a lot of things that the National Treasury has been spearheading, and around money laundering, et cetera. But it's always very difficult to predict when that committee is going to remove you from the list. It's something, we've been talking to experts in that area, so we don't actually know when it's going to happen. But I think what we can say, what we see on the ground, is the fact that the government has been working very hard. But again, I think I just want to lean back to the upcoming government. I think there's going to be agency on a lot of things. We know that a lot of opposition parties, particularly the DA, is something that they have been, very focused on that. They might actually come up with ideas in terms of how to get our country off that list. The impact, I think it was very minimal during the period when the announcement was done. We saw the rand coming under pressure, and we saw some of the money coming out of the country. But I think over the long term, and also if you think about investors as well, it has become a little bit very cumbersome to open an offshore account. Like us, we make use of some of the offshore investors, and it has been very difficult to do that. But apart from that, I don't think economically, well, I mean, the studies could be done and come up with crude numbers, but I don't think it has been severe beyond the points that I've set out.
Well, the impact has been fairly muted.
Yeah.
Another question around universal basic income. So the questioner asks, the concept of universal basic income has gained traction in some circles as a potential solution to poverty and inequality. What are your thoughts on implementing universal basic income in South Africa, and how might this impact consumer spending patterns and investment opportunities?
Yeah, so I think it's very difficult because it's a very secular argument, right? That you make that somebody will be making. I think there's a couple of economists that have come forward and say, if you implement a basic income grant, what you're basically doing is to stimulate demand. And normally, when you stimulate demand, the economy grows. And when the economy grows, it means that there's more money for the government in terms of tax and, kind of, yeah, in a normal world, in theory, that's how it works. But our view is that is pretty much in line with a lot of other economies, that it always has to be done within the premise of prudent fiscal management. So in other words, the question has to be, how is it going to be funded? We don't want a scenario whereby it's going to be funded by debt because the country is already under pressure. The balance sheet is already under pressure in terms of debt. But again, I mean, and also, how much are you going to set that basic income grant? At the moment, it's about 350 rands, and the good thing is it has been funded from windfalls that the government has been having, so it didn't have to really blow out the government balance sheet. So if it can be done within the prescriptions of the current fiscal framework without necessarily resulting in the economy, the debt to GDP increasing, it's definitely something that could be explored. I think, like, just to summarize, the way we look at it is that we don't want sort of people that come and say, let's spend, without providing you with means for funding that spend. Those are kind of populist ideas that I don't like. So if you say, let's have basic income grant, you also have to provide a mechanism for funding it. As long as there's a mechanism for it, which doesn't result in us seeing our debt to GDP blowing out, then yeah, it can be implemented.
I don't know, we've got about 3 minutes left, so maybe just a question on my side, right? So the US is the largest economy in the world, right? They've got an election coming up soon, right?
Yeah.
Give us some insight in terms of what's happening in the US on the political front.
Yeah, so obviously, I think it's an interesting market, and people get energized, whenever it comes to the US, and get disappointed after elections most of the time because nothing changes most of the time. All right, so I think in this particular instance, obviously, we've got Joe Biden, who is what do they call him? What's the term they call? Presumptive nominee, I think. Yeah, maybe that's a correct term for the Democrats, and then we've got Donald Trump, obviously. So I think I want the conversation, when you think about the US, should go beyond those two people. But it should be rather about how is the next US government going to look like. That's the most important. It's something that a lot of people don't understand, right? If you think about the US, you've got three arms that are very, very important. You've got the Senate, you've got the Congress, then you've got the executive. And those three arms, you have to work together to get things done. And in this particular case, we know what Trump wants, we know what Biden wants, but the question is for them to be able to implement what they want. They need to be able to control the Senate and the Congress. And to be frank, according to projections that we're seeing now, there's a lot of possibility. I think if you look at polls, some polls are actually putting, Trump ahead of Biden. Some are putting it's neck and neck, right? So it could go either direction. But I think what seemed to be clear is that the House of Congress is probably going to go to the Democrats, and probably the Senate might actually be with the Democrats. So essentially, what we're having here is a scenario probably we're not going to have a clean sweep. Maybe could you have a Republican president and the Senate and the Congress essentially being controlled by the Democrats. So when you have such a scenario, it's going to be a compromise scenario, which is what the US is always about. You're never going to have somebody who is going to push through those radical ideas which they have. They always have to compromise. So I think that's those are some of the most important considerations, when you think about the US. But of course, I mean, if it happens that we've got a clean sweep of Republicans, there's quite a lot of policy changes that could come through. We understand that if you look at Donald Trump is known for deeper corporate tax cuts. He could probably push for that. We know that he's preaching in terms of immigration, so there could be a reduction of migrant flows. He could repeal some of the clean energy tax credits, and he could put blanket tariffs on some of the goods that are coming from China, and could have a complete withdrawal of support for Ukraine, tax incentives. So there are some of the policies that we know that are associated with Donald Trump, and when it